Hey, greetings, traders. Samantha LaDuc here, founder of LaDucTrading.com. I'm joined by our MacroAdvisor EDGE manager, Craig Shapiro, and we're here to talk about end of quarter, what we have going on with October, what on earth with bonds, and when do we get some relief? Inflation expectations right now with oil coming down and everything else macro to micro. So this is an Ask Us Anything type of format. Our lovely macro to micro. Oh, you know what? Just occurred to me that my speaker wasn't on, my mic wasn't on. So let's try this again. Anyway, greetings, end of the day, a little bit slow to get started here, but welcome macro to micro power hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our MacroAdvisor EDGE manager, Craig Shapiro. Happy that you joined us today. We're going to talk macro, obviously everything fixed income and bonds, as well as oil, dollar, you name it. So this is an Ask Us Anything type of format when we make this public facing. We typically do this daily for clients and part of our EDGE series, which is a product that Craig manages very much for pro-to-pro engagement, as well as those who manage money. I run our intermediate kind of level program, which is very much focused on macro trends, sector rotation, stock picking on more of a swing and trend time frame. We also have a community product, which is in our Discord, and it is very much about momentum trading. So we have our hands in beginner, intermediate, and advanced level discussions. This one is more advanced. And I'm going to throw it right over to Craig and say, Craig, give us a summary of what the heck is going on with bonds and when do we get a relief bounce?
Yeah. So we've been talking for a couple months here since the end of July, early August, when Treasury announced the increase in the debt supply that was going to be coming in both the third quarter, but specifically in the fourth quarter on accelerating fiscal deficits and the issues there. And we kind of pointed out that this was going to be a supply-demand imbalance that was going to be hard to deal with for Treasury. And so yields have been moving materially higher kind of since that end of July, early August date. Term premiums have gone from reasonably negative to positive in the bond market. So fixed income investors are running for the hills. And really, it's driven by this concept of supply-demand. So we have accelerating Treasury issuance. And on the demand side, we have less buyers, right? We don't have the Fed buying. We have the Fed actually engaging in QT. So they're really more of a seller than a buyer. We have foreign demand has been slowing. And so that really only leaves kind of retail demand, which is more price sensitive. And so we're seeing, continuation of yields moving higher. And, with respect to the Fed, these moves in the bond markets accelerated further after the Fed meeting. And we had talked about, I think, on this last time, was an expectation at the Fed meeting to remove cuts from the forecast in the SEP as the Fed was going to upgrade their assessment of the economy. And that's exactly what happened. We went from 4 cuts for 2024 to 2 cuts. And another kind of frying pan moment for markets, which realized that the Fed was not going to be rapidly returning to a liquidity enhancing regime. The Fed is concerned about sticky inflation. They are still desirous of a soft landing, golden path where they could bring down inflation without disrupting the bond market. But under really no instance are they thinking about adding liquidity. And so I think the collective psyche of fixed income investors is really realizing these supply demand dynamics that are in play. And so we're seeing, a very sizable backup in long end yields. Curves are beginning to uninvert and in some cases steepen out as long-term yields are moving higher. And we are starting to see some cracks as the impact of these higher yields hits various parts of the global economy and global markets. And so I think that's what the market is wrestling with collectively now. And, whether it's in Japan, whether it's in Europe, whether it's in the UK, I mean, all these developed market bond yields are moving back, very close to the highs again, as inflation again remains sticky. And, the global selling of fixed income exacerbates, around the world. So, it's precarious here, and the impact on U.S. equities, which I know is a focus for for everybody in this room, I think has been playing out to a large degree. And I know you don't see it as much in the S&P, and you certainly don't see it in the Magnificent Seven and the largest cap tech. And so I think there is a view that these moves in the bond markets really aren't impacting equities. They are impacting equities. I mean, the most levered securities in the markets are performing horribly. I think I saw the net leverage factor is down 15%, in the last 6 weeks. Banks are starting to perform pretty poorly. I mentioned that in my channel this morning. Bank of America making lows, and even some of the the global banks, which we could talk about that as well. And then the underperformance of small caps and IWM. I mean, the ratio, I put this in the chat today. I mean, Qs versus IWM has made another kind of very strong move to record highs, and the underperformance of small caps, which half of small cap index makes no money and is levered. So the tightening that's coming from these moves in yields are impacting, and I think eventually, whether or not it's later this week, next week, the next couple of weeks, I think ultimately it will hit the Magnificent Seven, the S&P, NASDAQ to a larger degree as we see flows out of equities on this idea that equity risk premiums, which are just too low, will move up, and multiples will get hit, and and broadly speaking, the indices will likely succumb to the pressure, and I think we'll break through this 4,200-ish zone, which is seems like a bit of support where the 200-day is, and I think we're going to trade reasonably through that level in the coming days, weeks, month.
So let's talk about that, because everyone is really, on a macro framework anyway, pretty much bearish. I mean, I can't even count the number of FUD videos that are making the airwaves from very large macro gurus, right? So the fear, uncertainty, and doubt of this bond collateral damage and all that entails for emerging market. Like, we look like emerging market in the making. So as it relates to the Magnificent Seven, or that kind of NASDAQ bid, will you expect a kind of a pain trade? Steve Sosnick kind of said that today in his a message on Twitter, that basically when we get a very strong bond rally, when we get it, we're going to have obviously the potential for NASDAQ to kind of sell off. Now, I'm curious about this, because I had said the past few days that in lieu of some government intervention, I still see VIX moving higher. So it's not done just because we hit my price target of 20.44. It's one of those deals where it's still grinding higher very slowly and then all at once. So in this regard, we've got some potential Bank of Japan movement. They tried anyway yesterday, and talk about that a little bit, but it didn't really stick. What will we need for you to kind of see intervention coming in, government, Fed, Treasury, Bank of Japan, other, to put a rally or a bid, at least a short-term bid in bonds, which are extremely extended, like 2 standard deviation move oversold?
So I think there is way too sanguine of a view about what the Fed can and will do, and what they should do. And there's too much narrative about that the Fed needs to do something. I mean, I know I'm hearing bearishness, but I'm also hearing, well, the Fed's going to step in. The Fed's going to step in. The Fed is not going to step in. There is nothing for the Fed to do here. The backup in long end yields is precisely doing what they want to be done, which is assisting their desire to bring down inflation back down to 2%. This is planned. They want the market to help them, and when the markets fight them, which has been happening forever, as we talked about continuously, we talked earlier this year about 6 rate cuts were priced in for end of 23 and for 2024. And the Fed pushed back against that aggressively, and the market didn't believe in it. And now finally, the market says, okay, we think we believe you. And so the market is now working with the Fed to tighten financial conditions. This is what they want. So
but at
I
the
think
same time, those rates have been parabolic as it relates to the rate of change.
So the question is,
speed.
what rate of change is something that we need to watch. Volatility of fixed income is certainly we need to watch. And so we finally, in the last couple days, have started to see rate volatility move up. The MOVE index has moved higher. So yeah, we are getting to points where government actors are could have the potential to do things. But what are we even really talking about? I mean, basically what happened in March with this backup in yields was that there was a run on banks. There was a bank that had a deposit issue. The Fed has put a facility in place to prevent that. So it's slowing down any deposit flight that could be associated with a bank failure at this point. So there's no, and as bonds sell off, the BTFP continues to get used. So I think the Fed, from their perspective, has done what they needed to do here to give banks time to get their house in order. And now we'll kind of, let this see fit. Now, there are other actors out there. We mentioned the BOJ and Japanese Ministry of Finance, which deals with currency and JGBs. Again, uncertain. Yesterday, there was rumors of a MOF intervention at 150. I actually don't think they intervened. I think this was a barrier option structure that was reached at 150, and someone got too long dollar yen at that price once we went through to 150, and so they slammed it back down. Because if this was a Japan intervention, we would have went down, yen would have rallied and would have stayed there. So I don't really know if maybe this is a rate check by them.
I don't know about that. We did have this double up play back in September, October of 2022.
Yeah, I guess my point is that this is like not
do it again a month later.
Yeah, I don't think this. I don't really think that the Bank of Japan or Japan cares too much about a weakening yen when the rest of the world is seeing weakening currencies versus the dollar. So Japanese, PMIs are 53, 54. The Japanese economy is performing incredibly well. Wages in Japan are finally seeing some positive momentum. And in their view, inflation is still under control and really not even back to 2%. So I don't suspect they're going to be, intervening in the yen, here at 150. I think dollar yen is going to keep moving and probably move up to 155, 156 before we maybe see something. Now on JGBs, that may be a different thing. There has been a desire of the BOJ to kind of slow down the pace of yield increases, and so there was a big intervention last night. But 5-year JGBs made new highs. And 10-year yields and 20 years and JGBs are making new highs. So again, what is the, what are these governments fighting against, and why will there be intervention? I think, really what we had today was maybe the first kind of real sign of intervention, and it happened in the oil market, really. And I don't exactly know, why oil specifically was down 5% today. We may never know. But, one way to kind of break the heat of the bond market would be to get oil down. So we know CATAs were long, they certainly were deleveraging today and kind of getting unwound today. There's been talk about the US being in Saudi Arabia and trying to make some sort of global peace deal between Saudi and Israel. I'm sure they want to, again, these are, theories and conspiracy.
Also, 93.50 is nice monthly resistance for those technical traders.
So
there's also a lot of speculation that ran up on storms and fires and what have you, and supply cuts when demand showed yesterday. No, this morning.
No, today.
Gasoline demand is dropped.
Right. So I think that this is where we could get the relief. And I'm not too much of I am a conspiracy theorist, but I don't know if there was, future selling of oil. It doesn't really matter. The truth of the matter is oil came down because for a variety of reasons, one of which was the data today. And look, high oil prices globally are impacting demand, right? They are impacting demand here. They're impacting demand in Japan and the UK and Europe, and really any energy importing country is struggling with these higher oil and higher gasoline prices. So we know high prices kill high prices. We eventually destroy demand. So maybe we finally have collectively hit that. I'm not really sure that oil falling on demand weakening is actually going to be a risk on environment, but I can understand why today, as oil fell, yields fell, and that led to tech outperformance, right? It's hard to break down that algo correlation.
They didn't fall them very much. I mean, the dollar is still extremely
I agreed.
Yeah.
So
bonds are still in a terrible, protracted downtrend. So it very much for me was just stockpiles and
and I think for sure. And as far as the data just in the US today on the macro side, the bond market has been very oversold. And so when you get an ADP report that is worse than expected, there's relief there that the labor market is actually slowing. And so, given where bonds had gone to, 20-year yields at 5% plus overnight or last night, and actually 30 years I think almost hit 5%, or maybe they did. You can understand why there was relief there this morning. Now we have claims tomorrow. The services ISM numbers were pretty good, generally speaking. There was a deceleration in new orders, but prices paid reaccelerated. Employment is still above 50. So I think the service economy is still okay. Claims tomorrow will be interesting, because if we don't see any positive momentum on continuing claims or initial claims, the setup for Friday's payroll print, will be one where people may start to fear again that that's a big print. I think we are getting to a point where it's a bit binary on Friday, right? I mean, if the labor market now shows a strong print with strong wages, I mean, bonds are going to get killed. Vol's going to rip. The dollar's going to explode.
Or the opposite, a short covering in bonds, at least for short.
So I think the way this is going to go down, personally, is I think we are going to see equities correct more violently over the course of the next several days, and it'll ultimately be that correction in equities which gets people to start buying bonds again. And so I just don't think we're there yet. Can we get there later this week on it? Yeah, it's possible. That we have to wait until next week when there's massive bond supply, which there is next week. There's huge auctions next week. And
let's talk about that, because duration risk is now triggering some credit risk in the last 9 days. And this is from yesterday's print. This is high yield OAS. But the point is that is definitely increasing. We already know about cost of capital and value of collateral and all that. But as it relates to credit, it is starting to widen out. What's your take on this?
My take is it's taken very, very long to finally start to get credit to widen, but we are now here. And so I think what folks need to remember is that the first signs of stress are not going to be the ones that force government or Fed intervention, right? We're just starting to see spreads move. I mean, spreads are not even close to the wides of the year. They're significantly tighter than they were during the SVB issues. So I think we need to give some time to allow markets to play out here. So spreads are widening, IG spreads are widening, high yields are widening, Italian versus German spreads are widening, European financial spreads are widening, CDS in banks is widening, right? There is a run on collateral, because collateral is based on government securities, which are losing value. It's forcing system deleveraging. More levered entities are being forced to take down risk, and it's leading to spread widening. So I think we need to see this play out and see this through, as opposed to trying to find some sort of interim bottom here, right? And I think the reason that we're getting a little bit more of spread widening is because the macro data in the US and globally is showing increased signs of deceleration and likely stagflation, right? I mean, we still have sticky inflation, and we clearly have decelerating growth momentum. PMIs again, globally, we're not very good. Specifically in Europe, we're not very good. And China showed kind of a flattish versus last month, not really much momentum there. And the US, manufacturing PMI wasn't great. So I think we're seeing that deceleration of economic growth continue amidst still tight labor market where wages are still firm, and an inflation environment which is not slowing rapidly. So I think that's the inflationary setup is the reason why we're starting to see credit spreads widen. More companies that have levered balance sheets are getting hit more, and financials, which are at the teeth of all this, are really under pressure.
So let's talk about this chart real quick. This actually is the E-minis on top with Fed balance sheet basically underneath. So you were talking about more issuance coming down. This is the peak right here, 31st. We actually have been really kind of tightening underneath the surface, liquidity leaving, in other words. And this is definitely timed with market weakness, just to kind of show. This is on a daily chart. I know you've tracked liquidity all different ways. So do I intraday. I've got, my breadth indicators from intermarket tells, but also net volume of selling and buying, which really, really helps to kind of time the directional inflection points as well as the duration of a move and the intensity of a move. This has been very, very solid selling underneath the surface since August 1st. And you had mentioned, obviously, the Treasury issuance on July 31st. So even the Fed balance sheet has obviously continued to tighten. What's your take on what's coming down the pike for issuance for the rest of October and into the end of the year? Like, when do we have the heaviest supply hit the market, which is obviously not good for bonds, and continues to push yields higher, which at some point will trigger more equity selling in SPY and NASDAQ. But for right now, what's your read on Treasury issuance?
Yeah, so actually the biggest liquidity drain that we're going to get, for the rest of the year is going to happen in the next 2 weeks.
Next 2 weeks.
Because what we have is we have a combination of very sizable auctions next week, and then we have the October 15th tax payment. So we're going to have a very sizable draining of liquidity here out of bank reserves, really in the next, 2 weeks, $150 to $200 billion worth. Now, again, some of that will come out of the RRP, and we continue to see that. So, but the Treasury general account is likely to get above 800 billion. Call it on October 16th or 18th, or, the day after taxes are paid. And Treasury has said that they expect that TGA to be at 750 billion for the end of the year. So we're going to be at a very tight liquidity situation, call it, 2 weeks from now. We are still going to have, between now and the end of the year, a continuous issuance of duration and more every month versus the last month. So there's a mix issue there, right? We're replacing bills with bonds, and so that has a impact on markets, but it doesn't necessarily impact that Fed liquidity chart that you put up. Now, the other thing that we need to keep in mind is that Fed liquidity and Fed's balance sheet is contracting 90 billion a month because of QT, right? So that continues, no matter what. But it's this extra kind of TGA build over the next 2 weeks here, which will make this next period, a very tough one. So this happens every year at this point in time.
Okay, how about federal deficits, as we have shut down? Now I'm up in the air. They kicked the can, but I'm talking about McCarthy out, and you've been talking about this a lot. So
yeah, I think this is part of the Treasury bond sell-off, is a growing realization by market participants that there is no sustainable solution to these fiscal deficits in the US really anytime soon. Meaning, certainly not in the rest of this year or next year. There are some tax cuts that come off the books at the end of 2024 for 2025, but that's an eternity from now. Government in DC is dysfunctional, right? So, and now we don't even have a speaker. So there literally is no legislation. There's no process. There's nothing. There is going to be no spending cuts, and there are going to be no tax increases. So as the economy slows, the only solution here to paying our bills is more debt and higher deficits. And as rates continue to move higher and Treasury is issuing T-bills at 5.3, 5.4%, interest expense continues to grow, which blows the deficit out even further. So on the 10th, next week, we'll get the first read of September's budget expectation. That could be a catalyst here. If that figure comes in, kind of worse than expected and shows another 12-figure, $100+ billion deficit. Again, it's the market's going to be thinking about accelerating Treasury issuance, forever. What do I pay? Why would I want to own a 10-year, a 30-year, Treasury security when there's no hope that the Treasury is going to be slowing down issuance anytime soon? So, and as far as the McCarthy speaker thing, I just think it's an acknowledgement of dysfunction in DC. And the more that there is dysfunction, the more, as a foreigner who's looking to invest in safe assets, the more I'm scared about giving that capital to the U.S. Treasury.
Do you think an economic or more data prints pointing to economic slowdown versus this, nominal GDP that's just rising strongly, surprisingly? But if we actually start to see, like a non-farm payrolls big miss or other trend of job, permanent jobs actually falling, there just seem to be a little bit piling up in the direction of economic growth is slowing. Do you think that'll actually be kind of a bond bull's best friend moving forward? Not necessarily equities, but definitely a bounce.
Yeah, look, I think there is a recession coming in the U.S. And it's been pushed out for months, quarters, if not years, but it is coming. And maybe it's right around the corner now, and maybe we'll start to see the labor market really decelerate from here, and we'll get a pickup in claims and layoffs and a slowdown, a negative payroll print. So I think that would be constructive, especially where positioning is for fixed income at this point. But that is to me, that's the trap, right? It's the gap between when the data rolls and the timeline to when the Fed can do anything about it. And so right now we're still at a point where the data hasn't rolled yet. And so there's still a universe of folks investing in equities and investing in earnings growth and companies that can grow and maybe taking money out of bonds and putting into stocks. But once we get to that point where kind of the recession is front and center, when we get, let's say a couple months in a row of negative payroll prints or 4 weeks in a row of claims moving higher and above 250 and continuing claims moving higher, we will finally be at the recognition that a recession is on the horizon, with a Fed that is going to do nothing about it. And I think that is the air pocket. That is the point of concern for risk assets. But yes, I think if we got that Friday or into next week, we could see bonds kind of, have a rally back. But I don't really think that this is something to play for. You are still very much incentivized to keep money in the shortest duration T-bills up front until we get to that recession point. Because at that point, when we start to really think about when does the Fed's cutting cycle commence, that will be the time when you look to rotate out of your short duration investments. Because if you think the Fed's going to be cutting 4 times, 6 times next year into a recession, that 5.3% yield that you're getting for 3 months, then it becomes 5.1, then it starts to fall. So you may at that point seek to lock in longer duration type yields, whether it's 5 years or 7 years or something like that. But not, we can't put the cart before the horse here. There's still a Fed that's not going to be doing anything to address this growth slowdown.
So we've got a question in here regarding, narrative of intervention. That's mine, by the way, when I was just looking at the volatility that we were having earlier this week. But nonetheless, I'm sure there are others that feel that intervention is kind of front and center, whether it be emergency Fed rate hike, which I'm definitely not there, to just, again, they buy some bonds just to give bond bulls need to defend here kind of narrative. But curious what, I know you said they're not going to intervene. That's your baseline bet, but they have in the past, right? So, I mean, even Mega Japan did come in September of 2022, then again in October before it actually stuck and it was coordinated. It has got to get pretty bad. We're only at 4,300, not, 3,600. So it's a very, very different backdrop. But talk in regards to this dollar strength move also that you have seen and has been literally 12 weeks coming up this week, potentially, of green weekly closes. Where do you think we are heading with that, since yields have stayed more than sticky? We're talking about bond bounce, but dollar's actually a big headwind to equities.
Yeah, look, I mean, I think the question here addresses, what does intervention look like and what happens if it doesn't work? And I think what we need to keep in mind is that intervention only really happens when we're at prices where it works, right? Like the governments, the central bank, the treasuries only come in when things are so disrupted that they can do a bond buyback or a rate cut or whatever it is to force the prices to act in a way that it makes the intervention work. So I think we need to get prices to levels and fear that makes that intervention come. And so I just don't think we're at that point. At the point in time when we're at that point, when the VIX is, 30, 40, whatever it is, or the move index is, through 150 or whatever
not
it
a
is.
Historical average at 20. That's just not meaningful enough. Yeah.
So I think we need to kind of trade that path. We need to get to that point. And look, interventions also, happen a lot over the weekend, right? So, they're not going to happen randomly overnight unless there's a volatility blowout. So I think the question now is, with respect to the dollar and its strength, is first the question is, who is it impacting most negatively, and are they in a position to do much about it? And I think those who are having the biggest issue now are the big energy importers in Europe, in the UK, and Japan, whose weak currencies, when they have to buy expensive energy, makes that a challenging proposition for them. Their current accounts blow out to deficit. They have to sell U.S. assets in order to raise dollars to buy expensive energy. That's a problem for them. So, those would be the areas where I would say, it's more likely to see intervention. But again, why does Japan need to intervene here with dollar yen at 150 if they don't think that their inflation is out of control, and if oil just fell $5? So I think these all are interplaying. But I think the trend for dollar remains strong and up and to the right until the point where it creates enough angst, enough market pressure in credit spreads and in equity vol and in stocks to have an anticipation that the Fed will do something, come back into the market. And the asset that I've continued to say will anticipate that best will be gold. And the truth is, gold has been horrible. And so I think that gold continues to say that we are not close to getting Fed intervention and liquidity injections to stop whatever is going on in the bond market yet. At the point in time where gold finds its floor, it will be the first sign that, that there is a likelihood of liquidity being added back. I mean, and again, I don't think just because gold bottoms doesn't mean the next day equity, bonds rally and equities fall, but gold typically will anticipate best that eventual dollar liquidity being released. And we just haven't seen it yet. And I've been surprised. And actually the gold breaking down has made me more negative on equities, because to me, it suggests that we're even further away from government Fed intervention than I would have thought.
So I have, as you know, a technical and an intermarket read for gold, silver, and precious metals, which has been very much short. So we actually finally filled the weekly, gaps that very, very important to me, just from a technical nature. We absolutely took them out, in fact. Across the board for gold and silver. So I am really comfortable now saying it's time for it to base and then move higher. It was very, like oil often does, it moves very slowly, then all at once. So we had this big, it just needs a little trigger, push it right over, and then oil dumps, right? 5%, or what happened with gold and silver. Jeffrey has an interesting kind of take on this, and I have to share this because, he's also, sharing with clients his historical reference with gold and silver. And he says, when the cost of production increases like it has with higher dollar and yields, it actually squeezes miners very much so. And I kind of look at that with the oil and gas components that are that are down strongly, but also on the underlying miners down strongly, also the underlying. And I then look at the food stuff, all the packaged food companies. Like I was very, I guess grateful the timing that they started to roll over in May and June. They were on trend long list, doing perfectly fine. And then I'm like, this does not look good into the end of year. And they dumped. I mean, Hershey's is down 30%. So it's not just, and I mean, across the board, there are lots and lots of soft commodities within the food stuff or the packaged foods sector that has just gotten crushed, right? General Mills, Coca-Cola, I mean, you pick it, Smuckers. So soft commodities that it got hit, gold and silver got hit. Oil is now starting to roll over. Lots of folks are kind of looking at that as a deflationary impulse. His point was simply that when you get to this large move in dollar and yields, it actually it squeezes these producers big time. So it will start to show up on their balance sheets later, and now they're selling off now, obviously pricing that in later. So any comments on that?
Yeah, look, I mean, energy going up is a tax on the consumer, and it's a tax on, all corporations, right? There's this really very limited ability for companies that have no pricing power, like you mentioned, those staples companies or packaged food companies. They really don't have a ton of pricing power. And so when energy moves, their margins get squeezed. And we saw this, we've seen this at the end of cycles, at countless times, where the last thing to work is oil and energy stocks. And then once it rolls over, it's kind of everything rolls over. I mean, we saw this for sure. We saw this in 2008, where the energy and commodities bid was firm in the second quarter of 2008 and even into July of 2008. And then, once that started to roll over, once the higher energy prices, were impacting the consumer and impacting companies enough, everything started to unwind. It's possible that we've hit that point right now. I don't know, but certainly the trading activity of utilities and of less low activity, but I'm sorry, staples and some of these kind of low margin industrials that are impacted by oil prices. Yeah, I mean, I think this is indicative of end of cycle behavior. And if it's the case that we've had high energy prices long enough now to crimp consumer spending and crimp margins, then this is kind of classic end of cycle. And what we will get next will be a Fed cutting cycle amidst a recession. And that's, I do think that is going to happen. I just, the question is how rapidly does this all trade out? Yeah. And again, back to the original point, just gold, just to close the loop, I'm just pulling it back here, but I think gold, Gold put a bottom in let's see, like gold fell, you know, into the financial crisis in December, you know, into the lows into October of 2008. And then really once it never looked back and barely checked back in that first quarter of 09 move. And so I think gold will signal and liquidity. I mean, gold went from, I forget how low it was, but gold went from like 600 to, you know, 1,000 in about a 3-month period from October of 08. So, you know, after that final sell-off. So we'll see what happens, but that will be a sign, I think, once gold gets moving, that there's an anticipation of liquidity being added back.
So a few comments on gold from my perspective. One, I track it very closely as an intermarket tell, right? When it's trending and when, you know, big picture. And right now it's just not ready. It's got a base before it can move higher. So that's number one. It definitely has been a phenomenal also intermarket tell with yen and bonds. In other words, yen, bonds, and gold have all fallen. Obviously, bonds and yen probably as a percentage change has been outsized given it's a currency. Bonds has been historic 3 years in a row, very likely will have negative returns, but gold kind of goes with it's a basket trade for me. The interesting thing for me right now is going to be watching if treasuries, the rate of descent likely slows considerably, but it's still not safe. So I feel that the same way towards gold, basically, and yen for that matter. But as it relates to when they do start slowing and stop falling, we'll see the dollar stop rising. And looking for that turn, right, that whole combination is when gold will also start to get a bid. But we're just not there yet. So
can I just show one chart?
Yeah. Oh, quick? Sorry. Yes. So just an
Um,
answer to the question on
yeah, I mean, this is the chart of, you know, hopefully you can see this. This is gold versus real yields. This is gold inverted. So gold, you know, a fairly tight historical correlation between the price of gold and real yields. So when real yields are negative, like they had been in 2018, 19, 20, as rates went to zero, you know, gold had a strong performance, and I can even put it back even further. And there had been a fairly big disconnect that you could see. Sorry about that. Yeah, this is even further back, right? So this is dating back to 2010. You can kind of see how, you know, gold and real yields move together, they move together, and then boom, here, there's been a very sizable disconnect here where gold has significantly outperformed the move in real yields. And I think, if I'm thinking about this right, I think there had been a lot of talk, and even for myself, that, well, this is, you know, because you know, gold is anticipating that inflation will, you know, or will come back, or whatever it is, or the Fed will not be tight enough in order to stomp out inflation. I think what we're seeing now is as gold is falling, it's going back to its historical, and I'm losing the chart here, but it's going back to it. And now this is the other way. Let me just convert this, but gold is catching down again to real yields. And I think what this is suggesting is that the gold market is realizing that the Fed is going to remain tight enough to bring inflation back down to 2%. Now that may change, right? Mm-hmm. But I think this is why gold is flushing right now. It's kind of restoring its historical correlation to real yields. And look, the truth of the matter is, gold could really fall a lot more if it was going to reconnect here. I think most likely what will happen is maybe real yields will ease off eventually in the risk off, and gold will settle somewhere in the middle. But that's a precarious setup there for gold if that's the reality. And that's also a very precarious setup for risk assets if the collective wisdom of markets is suggesting that the Fed is going to remain tight enough for long enough to bring inflation down to 2%. I don't think that is priced into equities at 4,200 for sure.
Well, it's also a collateral, right? Gold is collateral in the same way that bonds have lost massive value as collateral. When margin calls come, what are they going to sell? Can't sell the bonds, but you can sell gold. So, there is that aspect of, I've always watched that. For example, even during the COVID crisis, let me just show that real quick here. This is hopefully make a little bit of sense. All right, this is an intermarket tell on a weekly, so kind of big picture, but this it shows a zero back in 2015. It happened to be the bottom, meaning it never gets below zero. We had this massive 5 standard deviation sell-off and gold, silver, with SPY during COVID. Now, of course, it got lit right back up, but it can still be very, very sensitive, if you will, to larger powers and that interplay with dollar and yields. So for me, it's still basing and oversold. It's not ready to move higher. Question on the high yield, of course, we talked about bonds, but HYG, JNK, any tells that you can kind of take away from their recent selling? Because I actually have a great chart that I posted for clients recently on that I can share. But first, your kind of macro view on, it's all part of the same bond trade, I know, but big picture, what you're looking for.
I mean, we mentioned it earlier, but spreads are finally, starting to widen out. I mean, HYG has struggled this year, but that's mostly because bonds have it's the bond component of HYG, which has led to the underperformance. I mean, basically spreads are not wide at all. I mean, here, I'll pull up another chart here of what spreads look like. And
yeah, but they are rising quickly.
For sure. But I think we need to just kind of keep in mind, like, where they are and where they could go to. I mean,
yes. So
I mean, I'll just pull back to even just the financial crisis. I mean, we kind of got down here. This is high yield, got down. I mean, it's basically been kind of tightening all year, right? Since this is SVB. I know it's hard. This is SVB.
It is hard. Let me show mine, because mine is actually really, I annotated it. So let's do this one real quick. All right. So.
But just to close it, but yeah, look, I think spreads have started to. Yeah, spread. Yep. This is HYG. Yes, so this isn't H. This is the spread. So this is good.
This is the spread. Excuse me.
Yeah. So spreads are, and I don't know if you can pull it back even further down, back to like a 5-year chart, maybe. I think that'll be more instructive.
Absolutely. So here. I know exactly what you're talking about. But my point is, it is definitely starting to. Here it is. All right. So big picture. This is again still the spread, but we have. Is that what you mean?
Yeah, look, I mean, you can see how much spread. Look at how spreads have tightened since SVB, right? So think about everything that's gone on. Everything that's gone on this year. Spreads got tighter, made a new tight for the year. 2 weeks ago, right? I mean, so and now finally we're starting to see some widening back out. But
that was yesterday.
Yeah, we're just kicking this process off. I mean, as far as refis are concerned and the maturity walls, I mean, 2024 will be a pickup over 2023, but it will not even be, a large pickup as far as the issuance needs of high yield issuers, as far as maturity schedule. But once we get to 2025 and 2026, I mean, we are talking about an incredible amount of duration that needs to be rolled.
Floating rate companies are in trouble.
Floating rate companies are certainly in trouble, but even just companies that were able to refi during the financial crisis in 2020 with 5-year paper, or in 2021 with 5-year paper, that's your standard for high yield. You're talking about 2025, 2026 maturities kind of accelerating. So the credit cycle, the credit event is coming. It's going to be slow moving, but it's not stopping. And we are in early stages of it. And so we shouldn't be thinking about getting in front of this with, well, credit's finally widening, so the Fed's going to step in. We need to get that mentality out of the narrative. And the more I hear it in the narrative, the more it makes me even more concerned, because I don't believe the Fed is operating with a post GFC 0% rate, no inflation.
You have mentioned that, and you've been right. So far, so good as it relates to keeping them out of.
Once inflation is slayed, and inflation expectations are slayed, and we are talking about less than 2% again, then the Fed will feel much more comfortable about providing liquidity to address growth concerns. But you have a trend in place where the long-term neutral rate is starting to move higher, and more folks at the Fed are kind of embracing the possibility that inflation going forward will look different than it has over the last 15 years. 15 years. Why? Deglobalization, demographics, labor force dynamics shrinking, whatever, global energy crisis, all these things that are, climate change, right? These are structural changes that are offsetting the deflationary tailwinds we had pre-COVID that came from AI and technology and all these other things. So in that environment, I think it's going to be, the bar is going to be higher for the Fed to act quickly to address growth concerns. I stick with that view. I don't see that changing and really anytime soon.
Just real quick, the chart that I showed in regards to Ravi's question, I took it down just not to distract, but it is something that I do track, Ravi, in regards to a spread anyway between high yield and treasury bond. I've got two of them, HYG to IEF, and then of course junk to IEI. So it's different duration of treasury over corporate bonds, and it's basically a way to see where they're going, right? So obviously it's been not in treasuries and more into corporate bonds, but it started to flip very, very strongly recently down. And that was something I had been waiting for, because if you notice, SPX has basically fallen from 46.07, and when I had posted this for clients, around 42.38, while these ratios were still marching higher. So the fact that they're now starting to roll over is why I started tracking the credit stress. Duration risk is credit risk. So I wanted to start really, really, staying on top of it. And that's in a nutshell. I don't see any resumption here of this trend yet until equities get some relief. So just to kind of answer that. The other question, let me just see if I've got this. About intervention. We also talked about economic growth slowing as a reason for bonds to bounce, but big picture, we're still bearish. And in particular, my intermarket and technical says not done. Same thing with VIX. But your treasury issuance warning is that the heaviest supply yet to come this month is actually more like the 16th. So it's not steady, it's all at once, or how does that work out for, just to recap that, because I'm not sure if I.
So you have to think about, so treasury issuance in and of itself is not necessarily liquidity additive or deletive. It depends on, what they're doing with the money, and, is it just going, are they issuing it and then putting right back in the banks, via government spending? So the issue for the very next 2 weeks is that the Treasury General account is going to rise by close to $150 billion, and that's a combination of that the issuance is going to be coming in next week and the week after, because that's just the calendar of when things are issued, but also the tax payments that need to be made by October 15th. So basically, individuals and corporations need to take money out of their money market funds or their bank and give it to the government. And so that money is going into the government's checking account and is not immediately being spent. And so that is the crux of the liquidity drain that is going to happen over the course of the next 2 weeks. As far as what's going to happen with respect to net issuance and the duration issuance, every month from now, certainly through the end of the year, and then at the end of October, we'll find out what the first quarter looks like. But I assume it'll continue. Every month, we're going to get more duration issuance. And by duration, I mean notes and bonds, as opposed to just T-bills. We're going to get more duration issuance every month than we got versus the prior month, because deficits are exploding. And the composition of debt is already above, is basically at the target, high end of the target for the bills versus bonds split. We're already at close to 80% bills And that's I'm sorry, 15 to 20%. We're already at 20% of bills, which is the high end of the range. And so it's unlikely that Treasury is going to continue to kind of refinance its balance sheet with very short-term paper. At some point, they need to issue long duration paper. And it's the act of issuing long duration paper that forces market participants to move their money out of short-term, whether it's these money market funds or bank reserves, and put it into the government's hands for longer. And so they're selling equities in order to buy a 10-year government bond, or they're selling a credit instrument in order to buy that longer duration bond. So that's a market dynamic that is in place, and it's that accelerated Treasury issuance that has a market, impact as the government is crowding out other places to invest. So that's less about kind of net liquidity. It's just more about the crowding out impact. So that's what I was trying to kind of point to.
Nope, that's the money quote. That's thank you very much.
But we're still going to get, we'll still, as we get QT, we still will get QT every month. So the Fed's balance sheet will continue to slide.
So we're still having waning liquidity. This is one point, and tightening, which we see in credit markets, and just that's helping the Fed do the job. Treasury, however, is uphill battle because they're still printing. There's no lack of federal spending restraint, and it's chaotic at that. So we don't really have any respite. We don't have any solution here. It's more of the same, and how long can they kind of keep it going before ultimately big tech starts to sell off, and maybe earnings will be a trigger for that. I mean, we've gotten weakness into the earnings season. We haven't kicked it off. Banks already look horrific. Unrealized losses might not be marked to market for Treasury holdings for banks, also, by the way, Apple and a few others, but it's not seemingly the reason for the season. It seems much more the risk premium in this this uninverting yield curve, and the fact that we are just starting to show signs of slowing. So that is kind of the double whammy. When will equities actually care?
Look, I think from there's a few different important, I think, timelines here now between now and the end of the year. I see there's a question about seasonality. We could kind of address that. So right now, I think we are in this, at a peak liquidity extraction period next couple of weeks here, as the Treasury general account needs to build, as there's massive issuance of Treasury securities next week. We're in a corporate buyback blackout right now, so we don't have that inherent bid underneath the market. And we're, approaching earnings season here, and we have big data point on Friday and another one next Thursday with CPI. So I think we're in a window here where, markets are very, potentially very susceptible to negative news and to negative pricing action. As we push through to the, throughout this month, and get past expiry, and we get into earnings season, and get through earnings, we'll get the corporate buyback bid back into markets. And the last 2 months of the year are the largest as far as impact of buybacks on on markets. So we have that's just an inherent bid under the market. If you think about, corporate buybacks are really like, basically they're like QE, right? I mean, it's companies that are insensitive price buyers of their stock every single day that the market is open. And it's irrelevant, what the price is, they just buy. And so there is this kind of latent bid, and less days trading in November and December. It means the bigger impact. We also will have the volatility buyback of hedges, certainly from the structured products that folks have talked about. And so there's a natural progression of buyback flows, and in years where markets are up into the end of the year, we typically get positive seasonal factors. So, as
let me show that real quick. Keep talking.
No, I was gonna say, so I think there's this I think there's this window here where markets are very susceptible to a large move lower. After that, what I think happens is we get relief. There's a bond rally. There's an expectation of liquidity. and the market bounces back. Where does it bounce back to depends on where we go, right? I mean, so, and how long is the bounce? It depends how violent is the correction. So it's hard for me at this point to kind of say, do we want to position now for the year-end rally if I think it's very...
No, we got to stop.
I think we
down.
need to stop going down first, and then we can make an assessment about when we want to buy, if and when we want to buy that dip, and for how long do we want to buy that dip for. I think the way this plays out is, again, down, rally back some degree of that, a 50% retrace, and then further down as we head into next year, as the market and investors start to come to grips with the reality of a slowing economy, recession, earnings headwinds, and inflation that is still kind of too hot for the Fed to aggressively move. We have rising equity risk premiums. We have falling earnings momentum. So we have negative, momentum on multiples, negative momentum on earnings, and we could get, much lower equity prices. I do think that reality is coming. So if I had to guess, it's like, down to 4,000, maybe even lower, rally back to 4,200 and then further down and, down to 3,500 at some point in the first quarter of 2024.
All right.
That's kind of how I see it.
So I'm just showing a few charts that are on the bullish bent because you and I have been bearish correctly. And now we're getting into a point where once we survive October, if we don't get taken out to the woodshed, we do have seasonality that has typically kicked in, right? From October until end of the year. We'll see lots of other statistics of breadth that folks are claiming that can be very market conducive to a rally. Archna, for example, saying stocks that are above their 50-day moving average got to 7%, which is exhaustion levels. I've got my own intermarket. It still doesn't show that it's done going down or safe to go swing long. A very large, massive SPX call spread position came in, assumed to be bought. I mean, this is 300 million in contracts, so notional is just a little bit bigger than that. Anyway, the point is there is definitely some bullish bent that can occur. I simply said we need to have intervention or signs of economic growth slowing, which would help give bonds kind of a relief bounce. And the question is, would that actually be bullish or bearish Magnificent Seven? Because they're the ones that are absolutely held the market up. We know we're in negative territory on returns for Russell 3000. We're flat for 2000. Forget diamonds. There isn't any other momentum in town than basically 7 to 10 stocks. So we're in the sweet spot where we could absolutely have a blowout on NFP. And by the way, you did ask about NFP. Let me just show you something. Where is my? That's the last question I think we'll get to because it's already 5. Sorry about that. I have some strong opinions on NFP, and I actually voiced them with clients this morning. So by the way, become one. Club or edge, this is what we try and kind of game what's going to happen next with a macro event and how is it going to affect stocks and bonds. But we definitely have a very big event potential with non-farm payrolls. If they happen to miss, we can trigger. We're incrementally very close to triggering recession warning. So long story short, this is a SOM rule, and we have been percolating slowly but surely higher. And it just basically says once unemployment starts going up, it doesn't reverse. So if we get basically an uninspired beat, maybe nothing happens. If we have a big miss and unemployment is much stronger than expected, not quite sure how on UAW and other strikes, which are massive right now, with the largest strikes in U.S. history going on right now between Kaiser and GM, Ford, and others. So long story short, we do have risk of a recession being pulled forward even as soon as Friday. So it's kind of place your bets. But anyway, long story short, we don't know. Any other comments on NFP or in general macro event risk coming up? So we can close our power hour and remind everyone that where they can find us, because this is good stuff that we give out publicly on occasion. But we also have obviously Craig's phenomenal product, which is very much macro focused, very active with clients and really bespoke and one-to-one, pro-to-pro. It also comes with a club, which is my product, Live Trading Room, if you have the time. Otherwise, I've got a trend portfolio, swing portfolio, and lots of intraday levels to chase. So last comments, Craig, on the non-farm payrolls and other macro event risks coming up.
Yeah, it's very, I mean, look, we have tomorrow is claims, and then Friday we have non-farm payrolls, and then next week is PPI, CPI, and I mentioned the budget statement, as well as I think the minutes are next week, and then University of Michigan sentiment. So there's a lot of data, but yeah, Friday is key. Markets are oversold into Friday. Both the bond market and the equity markets are oversold into Friday, but markets do crash from oversold levels. So absolutely. I think there is the possibility that on a strong payroll print where wages are firm, there will be some fear about the bond market selling off and equities kind of re-accelerating their moves lower. And then into CPI next week, there's obviously an expectation for core to come down. And we'll see. I mean, if that happens, that could put a floor in the market from oversold. But if it comes in hot, then we could continue to sell. So a lot of data next week, plenty of Fed guys speaking, although they're not really saying much as far as I could tell. We're hearing from each incremental member about whether or not they believe in one more hike this year and how many cuts for next year. I thought it was interesting. Even Bostic, who is a perceived dove, basically said he only is pricing in one cut for next year. And late next year, he's actually now a hawk, as it turns out. So tomorrow we get Kashkari speaks, Barkin, Daly, Barr, and then Waller's on Friday. And then next week, another 10 of them speak. So there'll be a lot of back and forth chatter. And so there's always a potential for Fed words when markets become disorderly that we got to keep in mind. But I think that the Fed has kind of made its bed. We may or may not get one more hike this year, and we're not getting any cuts in the first half of next year, at minimum. So the Fed is far away from providing liquidity. We may be getting a turn in the data negatively here, a possibility if we get that on Friday with payrolls. We'll see. But I am very concerned about risk asset prices right here, right now, as liquidity is going to be withdrawn over the course of the next couple of weeks at an accelerated pace. And the seasonals are poor, and the buyback window is closed. And then if that doesn't play out, then after that, I'll tuck it away, and we'll kind of we'll see what happens. But
and that's exactly my final comment. I don't see VIX done going up. I see absolutely sideways for a little bit potential, no question about it. But as far as its final resting spot before it's a real VIX crush, I mean a real sustainable downtrend in the VIX, we're not there yet. So long story short, to answer that question, this is something where I warned on September 18th, right? So we're only October 4th. We've only gone 50%. That's only to 20. 20 is like historical average. So there's so much more left that we can squeeze out of VIX. So long story short, I don't think the market is done playing us for downside and then stabilizing before we can get any durable bounce. It definitely is not risk on in my book on any front, macro, intermarket, or technical. So with that, I'm going to thank all of you for coming here. And we're a little bit late on that power hour, but I hope it was worth it. And we'll do this in a few weeks. And we wish you all very, great rest of this trading week. And talk to you soon, Craig.
All right. Take care.
All right. Cheers. Bye.